The dollar is rallying, and the rest of the world is feeling it. The US dollar has climbed broadly against a wide range of currencies, from major economies to emerging markets. That move is more than a foreign exchange story. When the dollar strengthens, it sets off a chain reaction across the global economy, and right now, that chain reaction is in full effect. Start with debt. Many countries, especially in the developing world, borrow in dollars. When the dollar rises, paying back those loans gets more expensive in local currency terms. A government that owes $1 billion owes just as many dollars as before, but now needs to hand over more of its own currency to cover that bill. That pressure builds fast. Commodities add another layer. Oil, gold, agricultural goods, most are priced in dollars. When the dollar goes up, those goods get costlier for buyers outside the United States. Higher costs can suppress demand, which ripples back through commodity-producing economies. The driver behind this rally is interest rate expectations. When investors believe the Federal Reserve will hold rates at elevated levels for longer, dollar-denominated assets become more attractive. Capital flows into the US to capture those higher returns. That demand pushes the dollar up and pulls investment away from other parts of the world, tightening financial conditions globally. Emerging markets sit in a particularly difficult position. Countries across Asia, Latin America, and Africa are watching their currencies weaken against the dollar. A weaker local currency makes imports more expensive. Fuel, food, raw materials. That feeds directly into local inflation, which puts pressure on those countries' central banks to respond, often at the cost of their own economic growth. Even US companies are not immune. Multinationals that earn revenue overseas face a simple math problem. When they convert foreign profits back into dollars, a stronger greenback shrinks those earnings. That matters to equity markets, especially during corporate earnings seasons when those translation losses show up in the numbers. So where does this go from here? That depends heavily on what the Federal Reserve signals next, and on incoming US economic data. If growth remains solid and inflation stays sticky, the case for keeping rates high stays intact, and so does the pressure on the dollar. If data softens, the calculus could shift. The practical point for anyone watching markets: track the dollar alongside the data. Federal Reserve meeting dates, jobs reports, and inflation readings are the key inputs right now. The dollar's direction in the weeks ahead will shape conditions not just in the US, but across every economy that borrows in dollars, imports commodities, or competes for global capital. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.